If you're a business owner, your retirement savings strategies looks very different from an employee's. You don't have a company pension, and CPP alone won't be enough. So how much do you actually need to retire? The answer isn't a one-size-fits-all, but today I'm going to break it down for you. Let's share some tax-smart strategies to help you maximize your wealth and keep more of what you work so hard to build. Hi, my name is Daniel Lau. I'm a portfolio manager and senior wealth advisor with Zenith Private Wealth Counsel, IA Private Wealth, and I specialize in helping Canadian business owners build, protect, and optimize their wealth. So how much do you need to retire as a business owner? Unlike employees, business owners don't have a preset pension to rely on. Your retirement funds are completely dependent on how well you plan, save, and invest. Some financial advisors said you need 10 to 15 times your annual income, while others suggest savings at least $1.5 to $2 million. But in reality, the number depends on your lifestyle, income sources, tax strategy, and business exit plan. So 1, your retirement lifestyle. How much will you spend? The biggest factor in determining how much you need is how much you plan to spend. Here's how different lifestyle impact retirement savings. Example 1, the modest retiree. John, 62, a former contractor, wants a simple retirement. He plans to spend $4,000 a month on living expenses, hobbies, and occasional travel. His income will come from CPP, $1,200 a month, OAS security, $800 a month, and withdrawals from his TFSA and RRSP. He only needs about $750,000 in savings to fund his lifestyle. Example 2, the active traveler. Susan, 58, owned a marketing agency and planned to retire early. She wants to travel for the first 10 years of retirement, spending $8,000 a month. She'll eventually scale down to $5,000 a month when she stops traveling. Since she doesn't have a pension plan, she needs about $2 million in investment to support her lifestyle. Example 3, the business sales retiree. Dave, 60 years old, owns a manufacturing company and planned to sell it at 65 for $2 million. He'll use the lifetime capital gains exemption to shelter approximately $1 million from tax. After tax, he'll invest $1.4 million and withdraw $70,000 per year tax efficiently. His business sale funds his entire retirement without touching his RRSP or TFSA. Your income sources. Where will the money come from? As a business owner, you don't have an employee pension plan. Instead, your retirement income will come from multiple sources. CPP. If you paid at the CPP, you'll receive benefits starting at age 60 to 70. The maximum payout at 65 is $1,364 a month, $16,000 a year. But most business owners receive much less. Old age security. At 65, OAS pay up to $707 a month, $8,500 a year. If your income exceeds $87,000 per year, you'll start losing old age security due to the clawback. RRSP and RRIF withdrawals. You can start RRSP withdrawal anytime but must convert to a RRIF by age 71. RRIF minimum withdrawals start at 4% per year at 65 and increase with age. Corporate investment and dividends. If you invest money inside your corporation, you can pay yourself dividend in retirement. Dividends are taxed lower than salary, making this a powerful retirement tool. Selling your business. If you plan to sell your business to fund retirement, tax planning is crucial. You may qualify for the lifetime capital gains exemption, which shields up to $1,016,836 from tax. Selling a business without proper tax planning could cost you hundreds of thousands in taxes. Tax smart strategy for business owners. As a business owner, you have more control over your taxes than employees do. Here are key strategies to maximize wealth and minimize tax in retirement. 1. Consider setting up an IPP. There are multiple tax and retirement benefits, but that'll be a topic all on its own. 2. Use pre-tax money to pay for all your medical expenses by setting up a healthcare spending account. 3. Use corporate investments for retirement. Instead of withdrawing all profits and in salary, leave money inside your corporation and invest it. Corporate tax rates are much lower than personal rates, allowing faster wealth accumulation. At retirement, you can withdraw funds as dividend, capital gains, or salary, whichever is most tax efficient. For example, Dave's business earns $300,000 per year. Instead of withdrawing at all, he invests $100,000 inside his corporation at a lower tax rate. After 10 years, he has $1.5 million invested, providing retirement income without high personal taxes. You can also consider using corporately owned insurance to further shelter passive income and enhance the estate value for your loved ones. We'll cover that in a separate video. 4. Plan your RRSP and RRIF withdrawals carefully. RRSP withdrawals are fully taxed as income, so timing matters. A common mistake is delaying RRSP withdrawals too long, then facing huge tax bills when forced RRIF withdraw at age 71. Consider withdrawing small amount in your 60s to spread the tax burden. Example, instead of waiting 71, Susan withdraw $30,000 per year from her RRSP at age 60. She stay in a low tax bracket and reduce the size of her RRIF, avoiding high withdrawals later. Use the lifetime capital gains exemption. If you plan to sell your business, The lifetime capital gains exemption allows you to shelter just over $1 million in capital gains tax-free. Example, Tom sell his incorporated business for $1.5 million. With proper tax planning, he qualifies for the lifetime capital gains exemption, sheltering $1 million from tax. He only pay capital gains tax on $500,000 instead of the $1.5 million, saving over $250,000 in taxes. How much you need to retire isn't just about hitting a dollar amount. It's about having a strategic, tax-efficient income plan. So here are the key takeaways. Retirement savings depends on lifestyle, income sources, and business structure. CPP and OAS security won't cover your full expenses. You need private savings, corporate investments, or business sale proceeds. Tax planning is crucial, mixing salary and dividends, optimizing RRSP withdrawals, and leveraging the lifetime capital gains exemption can save hundreds of thousands in taxes. The earlier you plan, the more wealth you can keep in your retirement. Every business owner's retirement plan is different. If you want a personalized strategy to retire tax efficiently, click the link in the description to book a consultation with me. I'll help you figure out how much you need, how to structure your business for retirement, and how to maximize your income and minimize taxes. I'll see you in the next video.